Millions of Americans are at risk of missing their car payments, and some are choosing to refinance to save money each month. But refinancing isn't a good fit for everyone. Let's dive into why so many Americans are trapped by their car payments and the pros and cons of refinancing your auto loan. If you're considering refinancing, you're likely doing it to lower your monthly payment or pay off your car faster. Before I get into whether or not refinancing is a good idea, you should understand there are three main benefits. The first is to take advantage of lower interest rates, which allow you to pay the least amount possible for your car each month. Depending on the economy, interest rates can fluctuate up or down. The second reason is switching from a fixed rate to a variable rate loan or vice versa, which we'll discuss later. The third, and what is also probably the most complicated reason, is to lower your monthly payment and extend your payment period. This can be good or bad, and we'll explain why in a bit. But before we get there, first we need to assess your financial situation and why you might be looking to refinance in the first place. If you're struggling to pay your car loan, you'd be surprised how many Americans are in the same boat. In 2024, the average monthly payment for a new car was $734 and $525 for a used car. But how much should you be paying for your car in the first place? This brings us to what's commonly known as the Rule of 35. The Rule of 35 is a recommendation for how much you should spend on your car, and it says that you should never spend more than 35% of your annual salary on a car. And 35% is generally considered the upper limit of what somebody should pay. Some experts recommend closer to 20 to 25%. But if you're spending more than that, don't worry. You're not alone. The average US salary is $60,000 a year. So if we use the Rule of 35, this would tell us that the average car would be $21,000. But the math isn't mathing. When you look at the average loan amounts in 2024, new cars were $41,000 and used cars were $26,000. That means the average new car is 68% of the average salary, and the average used car is 43%. I don't know, maybe with inflation we should just start calling it the Rule of 50. Sorry, I couldn't help myself. Now there are some alarming stats when it comes to overpaying for cars. When we look at the credit score spectrum, those who were teetering on the line of having bad credit were financing the most expensive cars. And those who were considered to have bad credit were taking out loans that were only $1,000 cheaper than those who had good credit. This is a problem because on average, the lower the credit score, the lower the income. And I think this demonstrates that regardless of income, people are prioritizing cars they want versus cars they can afford. This is one of the big reasons that auto loans are the second leading cause of debt in the US. And as you can see here, auto loan debt keeps rising and rising every year. It's safe to say that a majority of Americans are in debt, and in our next video, we'll break down where that line is between having a healthy amount of debt and too much debt. So make sure to subscribe so you don't miss that. So when it comes to your monthly loan payment, it's usually impacted by three factors. First is the total car cost, which we just discussed. And then we have the interest rate and the length of the repayment period. Now there are two types of interest rates, fixed and variable. A traditional fixed rate loan provides stability with consistent payments because the rate remains the same for the life of the loan. A variable rate loan has a fluctuating interest rate influenced by the overall economy, so your monthly payments can go up or down. And for a lot of borrowers with bad credit, it can seem worth it to take a risk on a variable rate loan, because if the market is forecasting lower interest rates, your monthly payments could be smaller too. The problem is, interest rates have been going up. In 2019, rates for new car loans averaged around 5.27%, but by 2024, rates for new car loans had risen to around 7.48%, and used car loan rates averaged even higher. So people who went with a fixed rate loan have fared much better in the last 5 years. To make matters worse for low credit borrowers who have higher interest rates in general, they're usually also on the longer repayment plan. The typical repayment period on a car loan is around 68 months, which is around 5.5 years. Regardless of your interest rate, the sooner you pay off your car, the better, because that will minimize the amount of interest that you'll pay overall. Now, there's a trend where the lower your credit score, the longer your repayment period is. Again, this makes sense. If you have less income, it's harder to get ahead on payments or keep up with the minimum payments. When we compare borrowers with the credit range of 300 to 500 to those with the high credit score range of 781 to 850, bad credit borrowers took an additional 8 months on average to pay back their loan, which means they'll have to deal with the high interest fees for a lot longer. And this combination of high interest rates, long payment periods, and overspending is reaching a bursting point, with the delinquency rate reaching 4.6% in September of 2024. That's almost as high as we saw during the 2008 recession. So now that we know just how desperate the situation is, here's what you need to consider before refinancing. For one, you can refinance your car loan with any credit score, but the higher the credit score, the better the interest rate. So considering whether or not your credit score has gone up or down since you got your loan is very important. However, auto refinance lenders may have unique minimum credit score requirements for qualification. So you have to make sure you ask around. And if auto refinance lenders aren't an option, you can refinance with another type of loan, for example, a personal loan. It goes without mentioning that once you secure a new loan contract, you need to make your payments on time. Most financial institutions report your payment history to at least one of the 3 major credit bureaus, and maintaining a history of timely payments can help you improve a bad credit score over time. Now, let's look at the pros and cons of refinancing your car so you can make your mind up on whether or not it's right for you. One of the biggest pros of refinancing is you can lower your interest rate and pay less overall for your car. This is the most obvious positive. If you can get a loan with a lower interest rate, you can save yourself hundreds or thousands of dollars. Plus, it can mean you can pay off your loan even faster. Whether you keep your monthly payments the same or increase them, more of your extra payments go towards the loan balance instead of interest. The first con is that lowering your monthly payment could cost you in the long run. You've likely seen the viral TikToks of new car buyers shaking hands on deals for super lengthy car loans in exchange for small down payments and a low monthly payment. Now, for starters, I hope these are fake and they probably are just an exaggeration of a serious problem. But people really do like to lower their monthly payments for psychological reasons. I mean, we've all felt this, right? We see a small number get deducted from our bank account and it makes things feel more affordable, right? But the truth is, it will cost you more in the long run. To prevent this, find a balance between monthly payments, interest rates, and payment periods. The final point is both a pro and a con, and it relates to your credit score. Let's start with the bad news first. When you submit a loan application, you allow a financial institution to conduct a hard credit check. A hard credit check could potentially deduct a few points from your total score and remain on credit reports for up to 2 years. This can be bad if your credit is already low, but the good news is it can be incredibly helpful in the long run. If refinancing makes it easier to hit your monthly payments on time, then that would help you build your credit score back up. After all, your payment history is 35% of your FICO score, so a new loan with better terms could have a positive effect on your credit score within a few months. Now that we've gone over the pros and cons, how should you actually refinance with bad credit? Refinancing with bad credit typically involves one of 3 options. First is personal loans. These are unsecured and offer flexibility, but they often come with higher interest rates compared to an auto loan. Second is home equity loans, which allow you to borrow against the value of your home, offering lower interest rates, but they put your home at risk if you can't make the payments. Third is auto title loans, not to be confused with an auto loan. Auto title loans use your car as collateral and can provide quick access to cash, but they usually carry high interest rates and shorter repayment terms. Of all these options, personal loans are often considered the most straightforward option where you don't have to put your home or car on the line. And they can have better interest rates too. CreditNinja specializes in offering personal loans to borrowers with low credit. So if you're looking to refinance, feel free to check them out. With competitive terms, an easy application process, and even the possibility of same-day payouts, CreditNinja could meet all of your refinancing needs. If you like this video, don't forget to like and subscribe for more great personal finance videos.